This is a student project by Tim Tabesha for Dr. Kaulu's Financial Statement Analysis course at the University of Zambia. The content presented is for academic purposes only and not actual financial advice. The members include Dennis Mwansa, presenter, Poch Pasha, financial analyst, Brian Kambole, researcher, Simenda Simenda, researcher, Pindwe Zulu, researcher. Welcome to Financial Statement Analysis presentation for Copperbelt Energy Corporation. We'll dive into the company overview, brief background. Founded in the early 1950s as a Rhodesia Congo Border Power Corporation, SEC is a Zambian power generation, transmission, distribution, and supply company operating in the Copperbelt province of Zambia in the Katanga region of DRC. Copperbelt Energy Corporation PLC is incorporated in Zambia under the Zambia Companies Act as a public limited company and listed on the LUCI. The company and its subsidiaries is involved in power generation, transmission, distribution, supply, and professional football through its club subsidiary. SEC has undergone progressive changes since its formation, but has stayed true to its business model, incorporating advancements to ensure the business evolves in a manner that responds to customer needs. The evolution of the business has cemented SEC's position as a key player in the Zambian and Southern African electricity supply industry. SEC is a member of the SAP and the pioneering International Power Trader in Southern Africa. The company owns and operates a multi-dollar power infrastructure largely with the capacity to ensure consistent uptime and supply, comprising 45 substations and over 1,070 of transmission lines, supplying power to mine customers in the Copperbelt province of Zambia as well as the DRC. Also embedded in its network are strategically located thermal power emergency generation assets, known as GTAs, with a generation capacity of 80 megawatts, as well as 34 megawatt solar power plant supporting our business operations, with an ambition to reach 300 megawatts of renewable energy by 2027. Type of financial reporting. The annual financial statements of Copperbelt Energy Corporation are prepared in accordance with IFRS and interpretations issued by the IFRS Interpretations Committee, applicable to entities reporting under IFRS. The annual financial statements comply with the IFRS as issued by the IASB. We'll now dive into the quantitative financial analysis. Profitability ratios. The graph here shows the return on equity, which measures the return generated on the capital invested by shareholders. It is a key indicator of profitability from the perspective of equity investors. A higher ratio is generally better, as it indicates that the company is efficiently using its shareholders' money to generate profits. A low ratio can indicate that the company is struggling to generate a good return for its investors. Net profit margin. The net profit margin measures how much net income is generated as a percentage of revenue. A higher ratio is generally better, as it indicates that the company is able to effectively manage its costs and generate a strong profit from each dollar of sales. A low ratio indicates that the company is not effectively controlling its expenses, that its prices are too low, which could be a source of concern for analysts. In this case, Copperbelt moved from 14% in 2021 to 13% in 2022 and increased to 36% in 2023. The gross margin. The gross margin measures the percentage of revenue remaining after subtracting the cost of goods sold. A higher ratio is generally better, as it indicates that the company has a strong ability to price its products effectively and control its production costs. A low ratio suggests that the company is either facing intense price competition or is struggling with high production costs. Operating margin. This ratio measures a company's profitability from its core business operations before accounting for interest and taxes. A high ratio indicates that the company's management is efficient at controlling its operational expenses such as cost of goods sold, etc., to turn sales into profit. A low ratio can be a sign of inefficient management or high operational costs, which could be a source of concern for investors. We move on to liquidity and solvency ratios. The current ratio. As we can see from the graph, the current ratio is a key liquidity metric that assesses a company's ability to pay its short-term obligations using its short-term assets. A higher ratio is generally seen as better, as it indicates that the company has ample liquid assets to cover its liabilities, indicating strong financial health and a lower risk of default. Conversely, a ratio below 1 means the company's current liabilities exceed its current assets, a negative working capital position that can signal a liquidity crisis. While a high ratio is good, an excessively high ratio might indicate inefficient asset management, such as holding too much cash or carrying excessive inventory. Quick ratio. The quick ratio provides a more rigorous measure of liquidity by excluding less liquid current assets, such as inventory. A higher ratio is generally considered better, as it indicates the company's ability to meet its short-term obligations with assets that can be converted to cash more quickly than inventory. This makes it a more reliable indicator of short-term financial strength than the current ratio. A low ratio can be a red flag for liquidity issues, as it suggests that the company relies on converting less liquid assets like inventory into cash to pay short-term bills. Cash ratio. The cash ratio is the most conservative for the liquidity ratios, as it only considers the company's most liquid assets, cash and money marketable securities, in relation to its current liabilities. A higher ratio is generally seen as better, as it indicates the company can satisfy short-term debts immediately without selling off inventory or waiting for receivables to be collected. While a higher ratio suggests a very strong liquidity position, an extremely high ratio could also indicate inefficient asset management, as holding too much cash can be a drag on profitability. A low ratio, however, is a negative sign, indicating potential difficulty in meeting its short-term obligations without relying on other less liquid assets. The interest coverage ratio measures a company's ability to meet its interest obligations with its operating earnings. A higher ratio is a positive sign, indicating that the company's earnings are comfortably sufficient to cover its interest payments, suggesting a lower risk of default. Conversely, a low ratio indicates that the company's earnings are barely enough to cover its interest obligations, signaling potential difficulty in meeting its debt payments and a higher risk of financial distress. Debt to equity ratio measures the proportion of a company's financing that comes from debt versus equity. It's a key indicator of a company's financial leverage. A higher ratio suggests a greater reliance on debt, which can increase the risk to equity holders and creditors, but can also magnify returns when the company performs well. Conversely, a low ratio indicates a more conservative financial structure with a greater reliance on equity financing, suggesting less risk. We move on to the efficiency and activity ratios. Asset turnover. This ratio measures how efficient a company uses its total assets to generate sales. A higher ratio is generally positive, indicating that the company is effectively utilizing its assets to produce revenue. It suggests strong asset management and a good return on investment in the company's asset base. Conversely, a low ratio is often seen as a negative sign, pointing to potential inefficiencies such as underutilized assets or an inability to generate sufficient sales from the company's asset pool. Inventory turnover. The inventory turnover was at 86.5 in 2022, then it moved to 88.7 in 2023. Receivables turnover. A high turnover indicates effective collection, but extremely high values may suggest overly strict credit terms that could limit sales growth. Payables turnover. The payables turnover measures how many times the company pays off its suppliers and creditors during a period. In 2022, it was at 16.3, then in 2023, it was at 19.7. Common size. Analyzing the common size analysis. In 2021, we see that gross profit was 29.6. It improved in 2022 to 36.4%, then in 2023 to 36.3%. The operating profit was 20.4% in 2021, reduced to 18.4% in 2022, then significantly increased to 54.3% in 2023. The profit for the year was 14.8% in 2021, 13.6% in 2022, 36% in 2023. For the common size balance sheet, total net current assets were 73% in 2023, 72% in 2022, 75% in 2021. Common size cash flow. From the cash flow analysis, we observed that operating cash flows remain positive, showing the company generates sufficient cash from its core operations. However, significant cash outflows are seen in investing activities, mainly due to capital expenditure, which is typically for a power and energy company. Financing cash flows reflect prepayments and interest payments, but overall, the company still maintains a positive net movement in cash in 2023. The key trends in operating, investing, and financing cash flows. Operating activities. Cash generated from operations has increased from 26.3% in 2021 to 39.6% in 2023. Investing activities, purchase of PPE increased negatively from 4.7% in 2021 to negative 11.83% in 2023, showing more capital expenditure recently. Financing activities, loan principal repayments increased from negative 2.25% in 2021 to negative 2.96% in 2023. The summary of key trends. Operating cash flow is improving overall. Investing cash outflows are increasing significantly. Financing cash outflows are reducing, indicating less reliance on external financing or repayment of debt. Free cash flow to the firm. Free cash flow to the firm is the cash available to all investors, both equity owners and debt holders. We can see that in 2021 it was at 77,325, and this is in thousands, and it increased to 111,374 in 2023. Earnings quality and red flags. Significant one-offs refer to unusual or non-recurring transactions that have a notable impact on a company's financial statements. In 2023, there is a notable impact of one-off items. For example, impairment of Kawombo Hydro project shows a significant impact on operating profit. Admin expenses also show variability, which could include accruals. In 2022 and 2021, impairment and admin expenses remain significant but less volatile compared to 2023. Comparison between net income and operating cash flow. We see that in 2023, net income was 1,349 in 2022, 50,816 in 2021, 15,885. Historical cost. The annual financial statements have been prepared on a historical basis, except where otherwise stated in the accounting policies below. IFRS uses a one-step impairment model based on the recoverable amount, while US GAAP uses a two-step impairment test based on fair value for impairment of non-financial assets. For revenue recognition, both IFRS and US GAAP follow a similar model for revenue recognition aligned with IFRS 15 or ASC 606. For property, plant, and equipment, all items of PPE are initially recognized at cost and subsequently shown at fair value. For leases, differences may include definition of lease components and lease term assessment. IFRS tends to have less detailed implementation guidance. For research and development, under IFRS, development costs can be capitalized once certain criteria are met. Under US GAAP, research and development costs are generally expensed as incurred. The impact on investors' decision making. Differences on how revenue, leases, impairments, and R&D are recognized and disclosed can affect key financial metrics such as profitability, asset base, and liabilities. For profitability and earnings quality, impairment approaches can influence the timing and magnitude of losses recognized, impacting perceived risk and management performance. Differences in lease disclosures may affect dates like obligations and liquidity assessments. Risk assessment variations in recognition and measurement affect balance sheet strength and profitability measures, influencing investor perceptions of risk creditworthiness and return prospects. The recommended investment decision is to hold. While Copper Belt Energy Corporation demonstrates strong profitability, liquidity, and solvency, along with improving cash flow generation and significant investments for future growth, the presence of significant one-off items like the Kawompo Hydro project impairment and the increasing debt-to-equity ratio warrant a cautious approach. The company's robust operational performance and strategic investments are positive indicators, but the investor should monitor the impact of one-off events and the trend in debt financing. Therefore, a hold recommendation is appropriate.